For your entire life, you always hear people telling you, go to school, get a job, get out of debt. You hear about how bad it is to carry debt. So naturally, it's logical to think that buying a home with cash or putting as much cash as possible into your home to avoid the massive debt associated with a mortgage is the smartest choice for your financial health.
Now, Robert Kiyosaki, as an investor, also the author of best-selling Rich Dad Poor Dad book, believed using debt to invest is one of the best ways to grow your wealth. He once said the poor and the middle class work for money and the rich have the money to work for them.
What he meant was buying or building assets that deliver cash flow is putting your money to work for you. While high-paying jobs means two things. You're working for money, and the tax you pay will probably increase.
Now, to those of you who don't know who Robert Kiyosaki is probably wonder why he is saying using debt is one of the best ways to grow your wealth. There's two types of debt, the good debt and the bad debt.
An example of a good debt is the debt of a condo that you own. The debt is good only as long as there are tenants to pay for the mortgage loan. So if the tenant stops paying the rent, your good debt turns into bad debt.
In the real world, not many people actually understand this term works. Not many people actually even talk about how you can leverage on debt to create wealth. Sometimes people even using the phrase of investing in property to describe buying a home they live in, because after all, the property is a big investment for them.
But investment property is most commonly known as buying a home that you don't live in. So when it comes to investing, we all know that there are two options available. First is making a cash investment, or number two, acquiring a mortgage loan to finance the purchase of the investment property.
Personally, we agree with Robert Kiyosaki. That's why in today's video, we are going to share with you why we believe you should choose to go with a mortgage loan for your property investment.
In another way, we will understand how we use debt to invest in real estate to grow your wealth.
What's up, welcome to VC. My name is Vincent.
And I'm Chloe.
Before we start our topic for today, let's start with a recall on cash buy and mortgage loan. Let's say you bought a property for 500,000. If you were to cash buy this property, you would be paying 500,000 straight from cash, or you do bank transfer, basically your own money. Ballin'.
So when it comes to a mortgage loan, you're going to take up a loan from a commercial bank. So with a 500,000 property, if you were to get 90% loan with 35 years loan tenure and your interest rate at 3.7%, you would be paying this loan for 2,125 monthly.
Yep, that was straightforward and easy to understand. Since many people are talking about purchasing a property with cash as the best way to do so, let's see what are the pros of purchasing a property with cash.
First, purchasing a property with cash, you'll be debt-free. No doubt that a mortgage loan is the biggest debt that you can have because it reaches up to 6 or 7 figures. Loan repayments can also make up a huge amount of your monthly expenses. Many people say that you could instead divert the money to savings or investing for a much higher return.
Yep, next, the minimal expenses. After you purchase a property with cash, automatically you don't owe anything on that property. In terms of investment, in the certain times you don't have to rely on the rent to cover your mortgage payment, which is a huge plus for landlords. This is also help to protect investors in the event of tenants stop paying or if there is any extended vacancy. So if your property goes vacant, there is far less financial strain.
And obviously, when you don't take out a mortgage loan, you don't have to pay for interest, which is what everyone doesn't like about loans because they have interest rates.
Therefore, if you're looking to cash purchase a property that you are going to rent it out, it will be pure profit. Meaning if you have immediate cash flow minus any minor expenses required.
Regardless of the amount of benefits that we mentioned, there are cons to purchasing a property with cash too. The first one would tie all of your cash in just one asset class. If you're planning to spend most of your savings to buy a property, then you may not be able to invest in other assets.
By getting a mortgage loan, on the other hand, you're not only able to invest in one property, but you have enough to invest in other property or even other form of investment.
Honestly, when it comes to purchasing a property for investment, we wouldn't suggest our clients to purchase it with cash. If you're still having a salary or income coming in, then with the cash that you have right now, you can actually invest in more than one property.
Yeah, let's say the property costs you 500,000, the down payment will be like 50,000, which is 10% of the property price. If you have 500,000 in cash, it's actually possible for you to purchase 8 or 9 properties, including all of the additional miscellaneous fee.
Yes, but of course, your profile has to surpass the bad bank. The next disadvantage of purchasing a property with cash is having no leveraging power. Now, leveraging in this context means using other people's money for investment. Although there are risks in financing a purchase, investors free up their own money to purchase more properties.
In addition, owners will have lower cash-on-cash return compared to a finance purchase property. So cash-on-cash is the return investors see on the cash they invested. Think about like you put 500,000 straight into the property, how long would it take for the rental to cover all of your expenses including the 500,000? Yeah, it will be obvious that takes so much longer compared to a mortgage finance property if you take a look at this way. This is commonly called cash-on-cash return.
This also means by paying cash rather than leveraging, investors eventually lose out the ability to make other people's money work for them. That's it for cash purchasing property. Now it's time to dive into mortgage loan finance property. The biggest advantage of using mortgage loan to invest in real estate is that you get to use other people's money. Many financial experts have said that you should use other people's money whenever you can.
Yeah, not that you're supposed to go to loan shark to borrow money lah. It still depends. But when it comes to investment, there are actually no other investment choices that you would allow to take on a loan from the bank than other business purposes.
For example, to purchase stock, bonds, or even gold. The bank don't lend you money for that. But with real estate, you can do so.
So when you get a mortgage loan, you have to put up a certain percentage of the property's money, but you still get the benefit of owning the whole property. You get to take advantage of the property's appreciation, then you get to use it for whatever you want. This allows you to hang on your capital and use it for other investments.
People actually don't like to talk about how purchasing a property with a mortgage loan actually allows you to leverage more of the bank's money. So why? That's because you're building your profile. If your profile is white as paper, banks don't know if you're trustable to lend you money.
But if you're having a mortgage loan, you'll be paying the repayment on time, right? And in addition, they know you have a monthly cash flow from this property. Your portfolio will be considered a stronger in the eye of the bank, also boosting your credit score.
This is how the rich get richer. With the same formula, they borrow, they earn, and then they borrow again and they earn again. You can actually agree that real estate doesn't make you from poor to rich, but it actually makes the rich get richer.
Yeah, in addition, purchasing a property with mortgage loan gives you more flexibility compared to cash purchase. As we mentioned just now, you're tying up for the big sum of money in your property, right? But with a mortgage loan, you're given more flexibility whether you're looking into purchasing another property or investing in other thing else or having that money for your daily use.
Yes, exactly. Nevertheless, purchasing a property with a mortgage loan does comes with cons. The first thing is something that many people don't like: interest rates. If you come to think about it, nothing exactly in this world comes free, especially if you're leveraging other people's money. And of course, they would want to earn money from you too. That's how business works.
Yeah, but if you know how to use it wisely, knowing how to leverage the borrowed money to earn more money, it's a win-win situation.
Yes, other than that would be having debt. Many folks strive to be completely debt-free because a mortgage is a large debt to take on, which can make some borrowers actually feel uncomfortable. But like what we mentioned earlier on, there are good debts and bad debts. If the property is earning money for you by leveraging other people's money, then why not, right? Actually.
Now, after talking about the goods and the bads about purchasing a property with cash and also taking up a mortgage loan, honestly, there is no true answer to this on which is better, right? It's all depending on you yourself, depending on your financial situation and what's your goal.
For us personally, we actually love taking up a mortgage loan specifically for an investment property.
Yeah, honestly, if you come to think about it, right, how long are you going to keep the property investment, right? If you're planning to keep it for 7-10 years, then is it necessary for you to pay off the whole property? If you're going to sell it anyways, you might as well just leverage other people's money.
Yeah, you have to remember that you're purchasing an investment property to rent it out, which then means if the rental covers your monthly installment, you're owning a property for free. Plus, if it gives you extra cash flow, even better. It's a passive income where you do nothing. The least effort put into that property, you're earning passive income.
Yes, we also agree that you should be using a good debt to build your portfolio and also your credit score in order to boost your profile and be able to leverage the bank's money to purchase even more properties. If you're looking to diversifying your investment into stocks, gold and etc., you can do so too.
Yeah, but of course, we're not saying that purchasing a property with full cash is wrong. Honestly, if we could, we would. But that's if we are financially sure we have at least double the price of the property in our account or cash in hand. Once again, this is mainly from an investment standpoint. If it's for our own stay, we definitely have another point on that.
Yeah, and here's the end of the video. Thank you for watching. If you're still new in this property market and looking for any good investment property to invest while providing you a good return on investment, You can watch this video right there to know more about the Airbnb investment compared to traditional way of investing.
If you're still in the midst of considering whether you should purchase an own-stay property or investment property first, you can check out this video right here. And we will see you in the next video. Ciao!